Hey everyone! Welcome back to the channel. With car ownership becoming increasingly common, many Americans are finding it tough to keep up with their auto loan payments. The suspense of how small financial missteps can snowball into major crises is both captivating and sobering. Join me as we explore the top 10 reasons behind the rising trend of car loan delinquencies. We'll uncover how economic pressures, poor financial management, and unforeseen challenges contribute to this growing issue. Discover the critical factors pushing borrowers to the edge and learn how to better navigate the complex world of auto financing. Number 10. Rising interest rates, the hidden cost of borrowing. The rising interest rates are a key factor contributing to Americans falling behind on car loans. The suspense of how these increasing rates affect monthly payments is both dramatic and alarming. As the Federal Reserve adjusts rates in response to economic conditions, car loan interest rates have climbed, making it more expensive for borrowers to service their debts. The thrill lies in the escalating cost of borrowing, which compounds financial strain for many borrowers. As interest rates rise, monthly payments increase, putting additional pressure on already stretched budgets. The hidden cost of higher rates means that even those who could afford their loans initially may struggle to keep up as their payments become more burdensome. This growing financial challenge highlights the critical role interest rates play in affecting loan affordability and borrower stability. Number 9. Increasing vehicle prices, a burgeoning financial burden. The soaring prices of new and used vehicles have dramatically impacted Americans' ability to keep up with car loans. The suspense of how these escalating prices affect loan balances and borrower payments is intense. As vehicle prices climb due to factors like supply chain issues and increased demand, borrowers face larger loan amounts and higher monthly payments. The thrill of this financial burden is evident in the strain it places on household budgets. Higher vehicle prices lead to larger loans and, consequently, more significant financial commitments. This situation makes it increasingly difficult for borrowers to manage their payments, contributing to a growing number of missed payments and defaults. Number 8. Worsening economic conditions, the broader financial strain. Worsening economic conditions have exacerbated Americans' difficulties with car loans. The suspense of how economic downturns and financial instability affect borrowers is both gripping and troubling. Economic challenges such as inflation, rising unemployment, and slower wage growth create a broader financial strain, making it harder for individuals to meet their loan obligations. The thrill of this economic impact lies in the domino effect it creates. As economic conditions deteriorate, borrowers face job losses or reduced income, leading to difficulties in managing their car loan payments. The interconnectedness of economic factors and personal finance underscores the complexity of managing car loans amid broader financial instability. Number 7. Increasing debt levels, the burden of financial overextension. Rising levels of consumer debt are a significant factor in the struggle to keep up with car loan payments. The suspense of how excessive debt impacts borrowers' ability to manage additional financial obligations is both dramatic and alarming. As Americans take on more debt, including credit card balances, student loans, and mortgages, the financial burden becomes overwhelming. The thrill of this overextension is seen in the cascading effects on loan payments. Higher levels of debt lead to increased financial strain, making it challenging to allocate sufficient funds to car loan repayments. This overextension exacerbates financial difficulties and contributes to a growing number of delinquencies and defaults. Number 6. Poor financial management, the collapse of budgeting. Poor financial management is a critical reason behind Americans falling behind on car loans. The suspense of watching individuals struggle due to inadequate budgeting and financial planning is both revealing and dramatic. Many borrowers fail to manage their finances effectively, leading to missed payments and financial instability. The thrill of this mismanagement lies in the consequences of poor planning. Without a clear budget or financial strategy, borrowers may spend beyond their means or overlook essential payments. The lack of effective financial management contributes significantly to the inability to keep up with car loan obligations, highlighting the importance of budgeting and maintaining financial stability. Number 5. Unforeseen expenses, the unexpected financial strain. Unforeseen expenses are a major factor in the struggle to keep up with car loans. The suspense of how unexpected financial burdens impact borrowers is both intense and troubling. Emergencies such as medical bills, home repairs, or urgent family needs can divert funds away from car loan payments, creating financial strain. The thrill of this unpredictability lies in the sudden and often overwhelming nature of these expenses. Borrowers may find themselves unable to adjust their budgets quickly enough to accommodate these unexpected costs, leading to missed payments and loan delinquencies. The impact of unforeseen expenses underscores the challenge of maintaining financial stability in the face of life's uncertainties. Number 4. High loan-to-value ratios, the risk of over-leveraging. High loan-to-value ratios are a significant factor in car loan difficulties. The suspense of how over-leveraging affects borrowers' ability to manage their payments is both dramatic and revealing. When borrowers finance a large portion of their vehicle's cost, they face higher loan balances and increased financial pressure. The thrill of this risk lies in the financial strain created by high loan-to-value ratios. As borrowers take on larger loans relative to the value of their vehicles, their monthly payments become more burdensome. This over-leveraging increases the likelihood of financial difficulties and contributes to the rising number of missed car loan payments and defaults. Number 3. Job loss or reduced income. The shock of financial instability. Job loss or reduced income is a major factor behind falling behind on car loans. The suspense of how sudden changes in employment status impact borrowers' ability to manage their payments is both gripping and distressing. Losing a job or experiencing a significant reduction in income creates an immediate financial strain, making it difficult to keep up with car loan obligations. The thrill of this instability is evident in the sudden and dramatic shift in borrowers' financial circumstances. Without a steady income, borrowers may struggle to allocate funds to essential payments, including their car loans. This financial shock underscores the vulnerability of borrowers to economic disruptions and highlights the challenges of maintaining loan payments during periods of instability. Number 2. Ineffective loan terms. The pitfalls of poor financing choices. Ineffective loan terms are a critical factor in the struggle to keep up with car loans. The suspense of how unfavorable financing conditions impact borrowers is both revealing and alarming. Many borrowers enter into loan agreements with high interest rates, short repayment periods, or other unfavorable terms that create financial strain. The thrill of these pitfalls lies in the long-term impact of poor financing choices. Unfavorable loan terms can result in higher monthly payments and increased financial pressure. Borrowers may find themselves struggling to manage these terms, leading to missed payments and financial difficulties. The importance of securing effective loan terms highlights the need for careful consideration when entering into car loan agreements. Number 1. Lack of financial literacy, the ultimate barrier to stability. The ultimate reason behind Americans falling behind on car loans is a lack of financial literacy. The suspense of how inadequate financial knowledge impacts borrowers' ability to manage their loans is both dramatic and revealing. Many individuals lack the necessary skills and understanding to effectively manage their finances, leading to poor decisions and financial instability. The thrill of this barrier lies in the profound impact of financial literacy on loan management. Without a solid understanding of budgeting, debt management, and financial planning, borrowers may struggle to keep up with their car loan payments. The lack of financial literacy is a fundamental issue that exacerbates other challenges and underscores the need for education and awareness in achieving financial stability. Thank you for tuning in. If you enjoyed the content, please hit the like button and subscribe.